Imagine standing at the edge of a bustling stock market, charts flashing before your eyes, each line whispering secrets about where prices might go next. You're not a beginner anymore. You've dipped your toes into investing, but the waves of numbers can still feel overwhelming. Today, we're diving into technical analysis, the art of reading those charts like a story, focusing on key indicators every intermediate investor should know. Let's unravel this together, step by step, in a way that feels like a conversation with a friend. Technical analysis is like learning the language of the market. It's about spotting patterns in price movements to make smarter decisions. Unlike fundamental analysis, which digs into a company's earnings or growth, technical analysis focuses purely on price and volume. Think of it as reading the market's mood through its actions, not its intentions. Let's start with moving averages, one of the simplest yet most powerful tools. A moving average smooths out price data to show you the trend over time. Imagine you're tracking a stock's price over 50 days, averaging it to see if it's climbing or dipping. It's like watching a river's flow instead of every single ripple. There are two main types: simple and exponential moving averages. The simple moving average adds up closing prices over a set period and divides by the number of days. The exponential gives more weight to recent prices, making it quicker to react to changes. Picture a slow, steady tortoise versus a nimble hare, both useful, depending on your style. Why do moving averages matter? They help you spot trends and potential reversals. When a stock's price crosses above its moving average, it might signal a buying opportunity. But if it dips below, it could hint at trouble, like a storm brewing on the horizon. Let's try an example. Say you're watching a stock trading at $100, and its 50-day moving average is $95. If the price jumps to $105 and stays above that average, it's a bullish sign. Maybe it's time to consider buying. But always check the bigger picture. No indicator works alone. Now, let's pause for a moment. Think about a stock you've been eyeing. Have you noticed how its price seems to follow a rhythm? Moving averages can help you tune into that rhythm, but they're just one piece of the puzzle. Next up is the Relative Strength Index, or RSI, a tool that measures momentum. It tells you if a stock is overbought or oversold, like a speedometer for market enthusiasm. RSI ranges from 0 to 100, with readings above 70 suggesting overbought conditions, and below 30 indicating oversold. It's like checking if a party's gotten too wild or too quiet. Imagine a stock's price skyrocketing. RSI might climb to 80, warning you it could be due for a pullback. Conversely, if it's been beaten down to an RSI of 20, it might be undervalued, ready for a rebound. But don't jump in blindly. Context is everything. Let's picture this with a real-world scenario. You're tracking a tech stock that surged 20% in a week, pushing its RSI to 75. You might hold off buying, waiting for it to cool down. Patience here is key. The market often rewards those who wait for the right moment. Take a second to reflect. Have you ever bought into a stock at its peak, only to see it drop? RSI can act like a guardrail, helping you avoid those emotional traps. It's not foolproof, but it's a guide to keep you grounded. Now let's talk about Bollinger Bands, which sound fancy but are surprisingly intuitive. They're like a price envelope around a moving average, showing how volatile a stock is. The bands widen when prices swing wildly and tighten when things calm down. Think of them as the market's heartbeat, pulsing with energy or slowing to a rest. A stock trading near the upper band might be overextended, while one near the lower band could be a bargain. But here's the catch. Prices can stay near the bands for a while, so don't rush to act. Imagine a rubber band stretched tight. It might snap back, or it might stretch further. Use Bollinger Bands with other signals to confirm your moves. Let's say you're eyeing a stock whose price just touched the upper Bollinger Band, and its RSI is 72. That's two signs it might be overbought, urging caution. Combining indicators like this is like cross-checking a map before a hike. It doesn't guarantee success, but it keeps you from getting lost. Let's pause again. Think about how these tools, moving averages, RSI, Bollinger Bands, could apply to your investments. Have you ever wished for a clearer signal before making a trade? These indicators are like lanterns, lighting up the path through the market's fog. Another key indicator is the MACD, short for Moving Average Convergence Divergence. It sounds complex, but it's just a way to compare two moving averages to spot momentum shifts. When the MACD line crosses above its signal line, it's a bullish sign. Below, it's bearish. Think of it as a traffic light for buying or selling. For example, if a stock's MACD line crosses above the signal line while the price is above its 50-day moving average, that's a strong buy signal. But if the MACD dips below and RSI is near 70, you might want to hold off. It's like reading multiple weather forecasts before planning a trip. More data, better decisions. Let's ground this in a story. Imagine you're watching a retail stock before the holiday season. Its MACD shows a bullish crossover, and the price is climbing above its moving average. You might feel confident jumping in, but always set a stop loss to protect yourself. Take a moment to think. Have you ever hesitated on a trade, unsure if the timing was right? MACD can give you that extra nudge, but it's still about trusting your gut and doing your homework. The market rewards those who blend intuition with discipline. Now let's talk volume, the unsung hero of technical analysis. Volume shows how many shares are traded, reflecting the strength of a price move. A price jump on high volume is like a crowd cheering. It's more convincing than a quiet spike. Low volume moves, though, might lack staying power. Picture a stock breaking above its 200-day moving average on massive volume. That's a sign institutional investors might be piling in, a powerful signal. But if the same breakout happens on thin volume, it's like a whisper in the wind, easy to ignore. Volume adds weight to every other indicator. Let's reflect one more time. Think about a stock you own or want to buy. Have you checked its volume lately? Pairing volume with RSI or MACD can confirm whether a move has real momentum or if it's just noise. As we wrap up, I want you to feel empowered. Technical analysis isn't about predicting the future. It's about making informed choices. These indicators, moving averages, RSI, Bollinger Bands, MACD, and volume, are tools to help you navigate the market's waves. If this journey sparked a new idea or perspective, drop it in the comments below, hit that like button, and consider subscribing to keep exploring with us. Let's end with a final thought. The market is a puzzle, and every indicator is a piece. You don't need to master them all at once. Just start with one, test it, and grow. What's the first indicator you'll try this week?